Have you ever wanted a tool that allows you to nail tops and bottoms in the market? Well, after years of testing countless indicators, I found nothing that compares to the power of divergences. They are the ultimate tool for spotting price reversion and, when used properly, can be a lethal weapon in your trading arsenal. I guarantee if you watch this video from start to finish, you'll learn skills that will make a huge difference in your trading journey. Divergences, otherwise known as divs, are when the price action of an asset moves in the opposite direction of an oscillator. If you don't know what they are, oscillators are a type of indicator that gives insights into the momentum of price. The two oscillators that are best for playing divs are the Relative Strength Index, otherwise known as the RSI, and the Awesome Oscillator, otherwise known as the AO. Bull divs are where price makes a lower low, whilst the oscillators make higher lows. This tells us sell-side momentum is weakening and we may have a reversal to the upside on our hands. Bear divs are where price makes a higher high, whilst the oscillators make lower highs. This tells us buy-side momentum is weakening and we may have a reversal to the downside on our hands. Here are some examples on the charts. Here you can see a bull div, price makes a low, then goes on to make a lower low, and whilst it does so, the oscillators are making higher lows. On the flip side, we have a bear div, price makes a high, then it makes a higher high, but as it does so, the oscillators make lower highs. As with all the other lessons, divergences are best woven together in harmony with the other tools that I've taught you. For instance, when occurring into levels such as support or resistance, zones such as supply or demand, or while sweeping a key level. These teachings are holistic in nature and are most powerful when used in conjunction with one another. Now let's talk about structure. You've seen what textbook divergences look like. Now let's talk about some of the guidelines we use when trading these structures. First, we're going to take a look at the RSI, as this is usually the indicator that most people have trouble with. Rule number 1, bodies. Divergences are always drawn using the candle bodies, not the wicks of the candle. If you struggle with this concept, flick over to a line chart and it may help you see things clearer as it removes the wicks. Rule number 2, resets. Resets are when price travels too close to the 50 level and in doing so resets the RSI. What this means is that the divergence is now invalidated and you should no longer try and draw it out or use it to form the basis of a trade. Textbook theory will tell you that the RSI has to go exactly to the 50 level to reset, but I like to be a bit more fluid with it and, generally speaking, count any taps down to or up to the 45 to 55 range as an invalidation for the divergence. Rule number 3, double confirmation. Although not specific to the RSI, we want to ideally see the RSI align with the Awesome Oscillator, with both oscillators diverging. This gives us a stronger signal than just one diverging in isolation. Rule number 4, overextension. Ideally, we want to see both peaks as overextended as possible on the RSI. This means above the 70 level for a bear div and below the 30 level for a bull div. Rule number 5, Goldilocks. As a rule of thumb, any divs that span too wide are also invalidated. Textbook theory will tell you that anything past 14 bars is a no-go. But I like to be more fluid with this rule in particular, and you will learn to get a feel for these as you go along. That said, I'd probably try to keep it under 18 to 20 bars. This then goes the other way, where we don't want the div too short. We are looking for perfectly structured arcs, not too wide and not too tight. Hence why it helps to remember this principle as the Goldilocks rule. Rule number 6, flat divs. Although we typically want to see a strong div diverging powerfully away from price, we may also see flat structures occur. This is when price is making a clear directional push whilst the RSI is creating a div with equal peaks. For a bull div, this would be a flat bottomed divergence, and for a bear div, this would be a flat topped divergence. For these, I would try to be more strict with your overextension rule and really only take them if both peaks are either above the 70 level or below the 30 level. Bear in mind with these that as soon as the divs go past the point of equal peaks, then the div is again invalidated as it's technically not diverging against price. As you can see, there are some nuances when trading divergences, and you'll probably hear different opinions from multiple traders. The best advice I can give you is to start a divergence journal, and through both back and forward testing, really try and get a feel for what the structures look like in visual form. We should also take each set of rules with a pinch of salt. This example on ETH illustrates what I mean perfectly. We have a divergence which gave a great playout. It was pro-trend as it was joining an uptrend. It was into a clean demand zone. It had a very clean arced structure. It was almost formed entirely in the oversold region, and it had the AO as double confirmation. But if we were to be entirely rule-bound and systematic about this trade, we would have skipped it, as the RSI has just invalidated itself as it's gone past the point of having an equal bottom. As you can see, the nuances take some getting used to, and I can't tell you where and when to bend the rules right now, as it's very much contextual. That said, if you prefer to be strict with your rules, you may do so, and then once you get a better handle on which rules you can bend, you can do this later down the line. With regards to the AO, there aren't really any rules. Textbook application would say to wait for 2 bars in the opposing color to form for confirmation, but I like to use this tool with more of a general feel for things as opposed to using it to snipe a particular entry at a particular stage in price action. Instead, we can use it to tell us clues about the momentum of the market, and from there hone in on other concepts in our toolkit to try and take advantage of this information. But just because there are more technical rules with the RSI, do not by any means underestimate the AO. Its signals can be incredibly insightful. This divergence, for instance, marked the weekly lows on Bitcoin. And where it may have been tricky to snipe an exact bottom using this tool, it gave us clear signals about the waning sell-side momentum of the market. As you can see, the repercussions into the playout are long-winded and powerful. The AO also has a couple of its own nuances, for instance, the triple humped divergence, where we see the oscillator putting in 3 humps, each coming closer to its point of reset at the 0 level. These are particularly strong signals and ones you should keep a keen eye out for. In terms of weighting, both the RSI and AO are equally powerful tools, so I don't want you to start thinking of one over the other. They simply have different ways of presenting their data. At this point in the series, you probably know what's coming next. That's right, our old friend, context. This is a particularly important lesson to touch on context. Why? Because when trading divergences, context is everything. Divergences work best when either applied in range-bound conditions or when used pro-trend. On the other hand, they can be very dangerous when trying to counter the trend, particularly when trying to step in front of aggressively trending markets. You may hear the term, the div will keep diving. And this is when you see something you consider to be a good divergence opportunity, take your stab at a counter trend trade, and then price simply continues to push, resulting in you getting violently stopped out. Be very cautious in this area. As mentioned, divergences are a very powerful tool, but are also a double-edged sword. And trying to counter aggressive trends is usually where traders get roped in on the wrong side of the trade and are punished accordingly. Now let's take a look at execution. As mentioned, we don't use the AO for execution, instead use it to support the trade and use the RSI for our trigger. What we're looking for is a candle to form in the opposing color, for instance a green candle for a bull div and a red candle for a bear div. We can take entry on the close of this candle, and from here what we want to see is a sharp push away from the divergence to tell us it's fully locked in. Be careful when trading divergences not to make your stop too tight. As we covered earlier, divs can keep divving, and even though you think you may have gotten your confirmation candle, we could always go a bit higher or a bit lower, produce the real confirmation candle and have the divergence play out. Don't be greedy and fall into this trap. And remember, you can always take another installment on the position once a div has started pushing away and given clearer signs that it's in motion. Now that we've covered this essential trading tool, let's move on to our next lesson. One shrouded in mystery but unbelievably valuable, our second pair of eyes into the market and a tool I simply could not trade without. Delta.